Hi everybody and welcome to today's event where we have the pleasure to present GreenMobility. To help us today's presentation, we are joined by CEO Anders Svær. In today's presentation, Anders, you will make a short, let's say, prescript of your current strategy update, of course, focusing in on the core markets, both to save cost and to preserve a little bit cash in investments, but I'm sure you will get into that. And then we will actually focusing more maybe on Q&A. So in the box down below, start asking questions right now if you have some. If you don't, I'm sure I have a lot that will also take us around, so I will not hold back. And do ask it in English, Swedish, German, Norwegian. Then I think I don't know any more languages, but do feel that but the presentation today will be in English to try and cover most of the investor base. But for now, Anders, I will hand the presentation over to you.
Thank you, Michael, and welcome everyone. It's a pleasure to give this update based on the announcement we made on Tuesday. So an update on our strategy for GreenMobility, looking ahead for 23 and essentially also beyond that. And I think where we start, both from the announcement but also presentation today, is really looking at what have we seen in the past year or past period. As you probably know, at least if you've been following us for a period of time, GreenMobility is a growth company, and that's been our core focus from since our launch in 2016, growing outside of Denmark, expanding to new countries, to new cities. Of course, also growing in the cities we have actually opened. But as many of you have experienced as well, the world has changed a lot in the past year. And if I remember back about this time of year, a year ago, coming into 22, we were very ecstatic. COVID was lifting in the last few countries, also where we were operating, and really looking positively ahead. And then just facing a number of various crises across the markets, some hitting all industries, some maybe even more specific to automotive. Supply chain was already an issue coming out of COVID, with parts from Asia and so on. We experienced it in delays in delivery of new cars in several of our markets, but still something that was manageable. Since then, of course, war in Ukraine, we have energy crisis in various forms across Europe, interest rates going up, of course, financial markets, at least in terms of new races, but also stock markets in general, really going down. And then also as a consequence, and also something we've seen in our business, is that consumer spending became, or at least it dropped across all sectors, of course, as a consequence of various price increases and other impacts on a normal daily life. So all of this, of course, that gives some background for reflection, and also really viewing at how are we looking, how are we assessing the years ahead, short term, long term as well. One of the good things is still that the interest for shared mobility in general has continued to grow. We see more and more cities really focusing on this as a core way of transitioning mobility in the city. We also see a continuous growth in customers, and that actually goes across all our markets. But of course, given the situation across, we also have to adapt and adjust our business, which is essentially what we've announced now, that based on everything we see, and I think also the uncertainty of when will we have something that could look like a normalized world, we've chosen to adjust our business. Key focus is for us now to make GreenMobility profitable. And while it may sound a little bit strange saying it like that, of course, profitability has always been a key goal for GreenMobility, but it was a little further into time. Really, we wanted to focus on expanding, getting some markets and a foothold across Europe before focusing on group profitability. We've changed that, so now really focusing on making the company profitable. We are already on a good path towards that. A key part of that is that we want to consolidate our markets and really focusing on the markets where we have the strongest position, meaning we have the biggest revenue per car. That's usually how we measure our business, our individual markets. And if you've been following our normal quarterly reports, that's also what we put forward. And by way of doing this, we've announced we'll close 2 of our markets, Sweden and Germany. In combination, we have 500 cars in operation today in those 2 markets, and all these will be reassigned to other markets. So we will maintain the same total fleet, but we will simply move it into markets where we have a higher matureness and also, of course, a higher revenue per car. And sort of to put this in perspective, I put in some figures from our Q3 reports. Obviously, we haven't provided our full year report yet, but in Sweden and Germany, we've had for Q3 respectively 800 and 3,800 krona per car in revenue. And if you compare that to the markets where we will move the cars to, we have between 5,500 and 9,500 revenue per car. So very simply put, we'll increase the revenue, and as we're working with more or less the same cost level across our markets, then obviously that provides for a better business. The process will be initiated now. So we've already started the process, and I expect that we will be done with the consolidation of markets by end of Q1, hopefully even sooner than that. Where will that take us? Because that's of course highly interesting. It's a key purpose of what we're doing, and it does have a positive impact on our business going forward. We will of course continue to grow our business. I think that's always the distinction between a growth company. We will remain a growth company, but at least on short term, do less expansions, but really focus on the markets we're in, where we can see that the growth actually continues. By doing this, we will also close in on break even by end of 2023. That's of course the first step towards profitability, which we expect to have on group level for 2024. But it also means, which is a very important part, that we don't expect to raise any new capital during 2023. Something that we previously announced that we had capital for well into 2023. Now we've actually eliminated that, so we don't have any expectation of raising capital. Our cash position is strong coming into 2023, and we continue to operate and build on our strong core markets. As said, the short term, and that meaning within 1 or 2 years, bringing the company to a group profitable level by 2024, and of course still maintaining our long-term ambition of being a leader in European sustainable car sharing. Our previous long-term aspirations of 35 cities and 10,000 EVs is unchanged, at least in volumes. But given everything that's been happening for the past years, the only logic thing is that it will take longer, but also based on a more sustainable and profitable company. So that was, in short, sort of a recap of the announcement we made on Tuesday and the actions we're taking, and it's something that we've initiated already. And I know there are several questions, so Michael, let's jump into the questions.
Yeah. They have pushed me a little bit out of my questions, but
you're in control.
Yeah, I'm in control. Perfect. Thank you, Anders. What about planned expansion into Ireland? And secondly, and there's 2-part question here. Have you lobbied for some kind of politicians to start looking at not giving so big subsidies to electric cars, but giving the subsidies to electric cars in a car mobility service instead, right? To get more cars out of the cities. I think we can all discuss that it might go electric, but it doesn't solve our congestion problems to have electric cars. And so the question here is to make better use of our tax money, I would say, in this supply chain crisis, and also because we also are missing electric cars. So there was a lot of questions. So Ireland, and secondly, I'm sure you would like to lobby that, but whether you're doing it.
Well, I never miss an opportunity to lobby for something that will help both, of course, our company, but also the overall course. If there's any way of promoting more shared mobility, not only car sharing, but shared mobility in general, that reduces the load on our cities, we will do that. I haven't seen sort of anything pointing that direction, so I'm not super optimistic. But the reality is that's usually where you see the big movements. One thing is for companies like ours, but also for customers, for users. What makes it more attractive for me to do something different tomorrow? We can do a lot, but usually it needs something more to really have a huge effect. But I'm still quite confident we see a sort of continuous change, also brought about by other things that cities and governments are doing. So step by step, it's definitely moving strongly in the right direction.
Yeah, and if I should turn the question a little bit, it's not only you, it's also your competitors who wish to go black. That means the expansion is not going maybe to happen in some cities who wants it, because it's maybe not that profitable, right? So both you and all your competitors are probably looking at not going to somewhere because it's too far out profitable. So could this push cities to start needing to think more about, if they want it, they need to subsidize? I think Germany, you have seen some possibilities there for maybe the city saying we want someone to run it, and thereby also supporting that it's profitable from start on.
Yeah. No, I think there's those two things would definitely, they have to be linked. I mean, there's no point in subsidizing something that's not doing anything good for the city and the environment as well. So it has to be requirements, both of them. And yes, we're ready to support it in any way possible, of course, and then we will also lobby for it. But I think first step is really to push the knowledge of that transition. And luckily, and I have to say, it is changing. I've seen a huge change in the past 5 or 6 years where I've been with GreenMobility. We've really gone from almost nothing to this is really a key topic for politicians and cities. So while we may not get sort of full subsidy for shared operators, all the trends and all the support is pointing in the right direction. So that is clear for me.
Then there's a question here. Did you take any cost upfront closing Sweden and Germany?
Maybe I think there was a part about Ireland as well. Just to,
Ireland. Sorry.
Just to comment on that. That's right. We've been looking at many markets during the past 3-4 years or so. So I won't rule out Ireland. I won't rule out anything. But on short term, the focus will be on running our core markets, and in time we will surely expand to new markets as well. And I'll make sure to keep Ireland on the list for sure. That's a promise.
And then, did you take any cost upfront on closing Sweden and Germany? I think maybe the question here, we haven't seen your Q4 report still yet. So maybe the question is, will you take the upfront in this reporting year, the closure of Sweden and Germany?
No, I don't expect so. The cost will be, well, let's put it in a different way. When we close a market, we move the assets, we move the cars, which is the main cost base we have. So remember, in our markets outside of Denmark, we have a very small cost base. So we don't have huge offices, we don't have a lot of local cost. The costs we have are tied to the cars, and when we move them, then the costs either move with them or disappears. So there are no more parking costs in Sweden once we move the cars, for example. The only thing that may remain is of course salaries for our employees. But as we are also, they are still of course part of the team, and they will help close down the markets, moving cars and all that. So there's still some operation in Sweden and in Germany. Of course, we're still live. I mean, today you can use our service in both countries. So there's not going to be a huge closing down cost. There might be some winding up cost in terms of some auditors or something, but that's still at a reasonable level. So we're not expecting any huge losses in closing those markets as such.
Then there's a question here: can you sell something from the market you are leaving? Can if you take the cars with you, do you then also take the assets or any values with you?
It falls in the same line. We don't have any. I mean, we have a very small like office where we have a small inventory, but it's a rental and it's like, I don't know, 10 square meters. So it's something we can sell, and everything else we have in terms of spare parts, stuff like that, we can simply move it. So there's nothing to sell, but I think that's also a big value for us.
And then there's a question here, maybe we take it in two parts. There's a lot of cars being moved to existing market. Are there room for those cars, or will revenue see a bigger drop than maybe we normally see when you move cars into, because you're doing it at once? And there's a lot of the new. But if we can start by that, are you expecting that we must expect some kind of a drop because it's a large movement of cars into markets?
Well, I think, of course, this is something we've considered as well, of course, and also why we've chosen to move them as we will. If we look at Belgium, we are actually I would almost say we're short of cars. We could use more cars. The same in Netherlands. Denmark, where we will also move cars to, of course, is our most mature market, but we still see additional potential in Denmark as well. So we will, of course, I would expect at least to see a moderate drop, similar to when we expand the fleet, which we did about a year ago. I know you remember, Michael, that gives on short term, it gives a drop because obviously average per car will drop a little bit, but we don't expect it to be more than that. We expect that the market will be able to support that, and within a few months we will be back up at the revenue per car that we are at currently.
And then there's a question here: you're closing down markets and focusing on core markets, but will you actually expand within the boundaries? Is there some cities in Denmark that could be interesting, big enough, Belgium, etc., within now your core markets, Netherlands, Belgium, Holland? So will you move to other cities is that within the boundaries of your strategic update?
For now, no. I think first step is we'll do this consolidation. We'll move the cars, but then once that's settled, and also where we can see that the revenue is back at the level it should be. Of course, then we will look at that. That's a natural part of our expansion plans as well, and something we do ongoingly. Of course, there are cities both in Denmark, Netherlands, Belgium as well. But on short term, the focus will be on this updated strategy consolidation, and then bringing the company to profitability.
And then a little bit of a bookkeeping question. I don't know whether you want to be that detailed. How are those 500 cars, around 500 cars, being divided between Belgium, Netherlands, and Denmark? Of course, if you do the modeling of your business, it has some impact because there is different revenues there. Have you given that already some thoughts?
Yeah, it's of course something we've looked into as well. Where does it make sense? And if you do it sort of very simply put, then we should move all for Denmark because that's where we have the highest revenue. But I think that would be too much. So it will be split between the three countries, as also mentioned. We will do the majority of the Swedish cars will stay in the Nordics going to Denmark. It's the simplest way. And Germany, we will reposition those to Belgium and Netherlands. We've also looked at it from a practical perspective, but as all three countries can benefit from more cars, then this split has been the best. But sort of the final split will be part at least latest from our Q1 report, because then it will be very very clear where the cars are.
Perfect. And then I actually think you kind of answered the second part of that question. You actually think that will be like when we see you normal put in cars in markets, when that will have the revenue impact per car, and you will absorb that. So I think you answered that in the last questions. Then there's a question here about loans and subsidies, whether there are some things happening because you're moving out of a country. The Danish Green Investment Fund gave you a big loan for expansion in Sweden and Finland, if I remember correctly, and it's stated here. Is that will those terms of the loan or mean anything that you are now retrieving from the Swedish market?
No, we have no change in the financial structure behind the loan we have from the Danish Green Investment Fund is still committed, and they don't have an issue in us moving the cars. Of course, I've been in contact with them as well to verify this. But I think, and it's actually a key part when we started the dialogue with the Danish Green Investment Fund. We did it for several reasons, but one of them was actually to find a financing partner where we had that flexibility, because when we work with leasing companies, then usually the cars are locked to that at least that country. So the leased cars in Denmark are more difficult to move to another country. For one, because those leasing companies are not always present in other markets. But the flexibility that we have with the Danish Green Investment Funds actually allows us to do that. Of course, like anything, there's some paperwork, but that flexibility lies within our contract, and also why there's no change to the agreement we have with them.
And then there was something. The second question is subsidies you got in Germany for on those cars. Do you need to pay them back when you move them out of the country?
Nope. We are the cars we have are under the let's say old agreement in Germany, which means that they are all free of any clauses now. If you buy an EV today in Germany, you need to hold it for, I think you have to hold it for 24 months now. But we are under the old agreement, and we are free to move them.
Perfect. Then I have a question, Anders. There was not enough that I didn't get caught in. No. 24 profitability is in the books, but profitability is not the same as cash flow, So I will give you a question where I say you only expand in the current cities. You are still expanding, your fleet and a growing company, and you are profitable, and you are not moving out of new cities. Does profitability also mean that you don't need to, in that situation, to raise cash from some external source in 24 if you don't see a new opportunity or expand into new markets, but only expanding and growing in existing market, and you're profitable?
Yes, that based on the existing business, we will continue to run and operate the company, and also without the need to raise additional capital in 24. So, and I would even say there, depending, of course, on how 24 evolves and 23 as well, then there is even we will also get to a level where we can start to support organic growth, but then it becomes a matter of how quickly do we want to expand, and I think that's probably a decision that we are far from making at the moment. But if we take, for example, that spring 24, we have an opportunity or the market suggests now we can grow into 10 new cities at once, which is probably a bit too much, but as a hypothetical, then that would most likely require us to raise some capital, but then it would be directly for expansion into new cities and still based on an existing business that is cash generating.
And then let's round it up. I know you are maybe a little bit bound, so I'm not asking you to give me specific things, but late 22, you gave the warning about consumer confidence and higher electricity prices. And you warned on the guidance. I'm not asking you to guide or anything, but How has that panned out? A little bit anecdotal, because if we are looking at someone reporting the consumer confidence was down, but it hasn't pushed the consumer that much as we are expecting, and electricity prices is of course also seem to be coming down, at least some. So anecdotal. I'm not asking you to give new guidance or anything today, but anecdotal, how has the business evolved since you gave a little bit that warning? Is it a little bit of maybe than you hoped for, or
No,
feared at that point in time?
But I think there's definitely an element in it. We also adjusted our guidance for 22. So and that was really coming into Q4, where we saw, okay, there is an impact across markets, that people seem to be a little bit more cautious, spending a little less, and that's of course combined with the electricity cost as well. So I think it could be worse, but it could also be better, to put it that way. I'm cautious, sort of optimistic looking ahead. You're right, we do see electricity price going down. It hasn't happened or materialized into charging yet. They have said very bluntly they need to recuperate what they lost and see a stable pricing. But I think that's definitely realistic. We'll see electricity prices going down in charging as well, and for our business as well, in at least in the first half of this year. That would be great. That would surely benefit our business as well. But I think the consumer sentiment is also across everything. I mean, when we all go to the supermarket, I don't know, milk has risen 20-30% as well. So it's across every parameter. And naturally, they will, for some people, then using car sharing, even though it's cheap, will be still too costly. But we also see customers in this period of time saying, look, now it's too expensive to have my company car or my second car at home, so I will sell that and then jump into car sharing. So there's also a change in sort of consumer profiles overall. So yeah.
And then the last question, then I'll let you off the hook, Anders. In the old model, the 25 aspirations, I know we are not longer looking for the 10,000 and 35 cities, but there was also an Ebit target in fully matured market in that. Now you're actually moving more markets, and you are maybe making those more profitable than you would normally be by expanding. Or is the 20% still the target, or could that be higher or lower for some other reasons? While giving this plans a little bit elaboration about the thinking there.
Well, I'm not gonna promise it will go above the 20. Of course, we will always do our best to get that. But I think if we can get to a point where we across all our current markets can present an Ebit margin of 20% or even just close to that, we are at a very strong position. So I would say I'm very happy with 20%. We will push to make it better, but for now, that's what I see. We do see the possibility that we can. So from the original presentation of the 25 plan, what we said was that we saw a sort of a ceiling of a revenue per car of 10,000 kroner. And then of course a cost level of around 7,500 kroner. So that's where the 20%, and that's more than 20, I know. But so we do see there is a room that we can grow above 10,000. But we should also expect, and that's reality at the moment, that cost level has moved as well. So it's, to me, we are moving both levels, but maintaining the 20%.
Yeah, so it's more, this will actually protect maybe some of the cost inflation. Thank you, Anders, and thank you to everybody listening in and asking questions. May everybody have a nice day.